Have you ever noticed how empires don't collapse when people expect them to? They collapse after the smart money quietly leaves. While politicians argue about trade wars and tariffs, trillions are already moving behind the scenes. This isn't chaos. It's not incompetence. It's a pattern that's repeated for over 300 years, and it has never failed. And once you see which stage we're in right now, you'll understand why the cost of living keeps rising and why the next phase won't be reversible. Most people experience history as noise. Empires rise, empires fall, markets surge, markets crash, and after it's over, experts argue about what went wrong, which policy failed, which leader made the mistake, which crisis caused the damage. But history doesn't actually move that way. It doesn't jump from accident to accident. It doesn't collapse because of a single decision. It moves in patterns. Quiet ones, mechanical ones, patterns so consistent that once you recognize them, entire centuries suddenly make sense. Here's the part almost nobody is taught. Economic systems don't break when people panic. They break after confidence appears stable, when the people closest to the system have already adjusted their position. The most dangerous moment isn't chaos, it's calm. Because calm is when exits are used quietly. Right now, on the surface, everything still looks functional. The US dollar still dominates global trade. Markets still open every morning. Salaries still get paid. Governments still borrow without immediate consequence. But underneath that surface, the numbers are telling a different story. Global debt has crossed 300 trillion. U.S. federal debt alone now exceeds 34 trillion. Central bank balance sheets, once measured in billions, are measured in tens of trillions. And none of this is treated as an emergency anymore. It's treated as normal. That normalization is the signal. Because this documentary isn't about politics, it's not about trade war slogans or partisan blame. It's about a four-stage monetary mechanism that has ended every global reserve currency in recorded history. Not through invasion, not through revolution, but through debt, money creation, and strategic capital movement. It happened to Britain when the pound financed empire through borrowing. It happened to Germany when money printing destroyed savings. And it already happened to the United States once before, in 1971, when the dollar quietly broke its final tie to gold. Each time the system didn't collapse overnight. It eroded. Confidence stayed high while purchasing power leaked. Markets functioned while discipline disappeared. And by the time the public realized something irreversible had happened, capital had already moved on. From the outside, moments like this look like political drama. Trade wars, tariffs, tough speeches, headlines about standing up to rivals. But underneath that noise, something far more important is happening. Capital is moving, not emotionally, not ideologically, but mathematically, quietly reallocating toward where growth, production, and future settlement power are expected to exist after the current system finishes overextending. In this video, we're going to strip away the spectacle and look directly at the machine underneath it. How modern money systems are built, how they expand beyond their limits, how currencies lose power without collapsing. And most importantly, how financial institutions historically move trillions of dollars before the damage becomes obvious to everyone else. This isn't about fear, it's about clarity. Because once you understand which stage we're in right now, rising prices, stubborn inflation, and shrinking purchasing power stop feeling confusing. They start feeling inevitable. And the only real question left becomes this: do you recognize the pattern while it's still unfolding, or only after it finishes? Before we talk about China, before we talk about Wall Street, before we talk about tariffs, trade wars, or political headlines, we have to understand the machine. Because once you see how this machine works, the rest of the story stops feeling shocking and starts feeling mathematically unavoidable. The global financial system is not chaos. It isn't driven by elections, and it doesn't change direction because of speeches. It runs on a four-stage monetary mechanism, a mechanism so consistent that it has quietly ended every dominant monetary system of the last 300 years. Not through violence, not through collapse, but through arithmetic. Stage 1, the brilliant fix. Every cycle begins the same way. A government needs more money than it can raise through taxes without risking backlash. War, infrastructure, social programs, economic rescue, financial crisis. The reason changes, the pressure doesn't. So a solution emerges that feels responsible, even elegant. A central bank. A monopoly on money creation. The government issues debt. The central bank buys that debt. New currency enters the system. At first, the results are impressive. Growth accelerates. Markets rise. Employment improves. Credit becomes easy. In modern terms, this looks familiar. After 2008, central bank balance sheets exploded. The Federal Reserve alone expanded from under 900 billion to nearly 9 trillion. Trillions were created with a keystroke, and nothing collapsed. That success is what builds trust. Because at the beginning of every cycle, the system works. Stage 2, expansion without pain. Once money creation becomes normal, something subtle changes. Limits disappear. Governments no longer have to choose between spending and taxation. They can do both. Debt grows, but interest rates stay low. Borrowing feels painless. Growth appears to outrun liabilities. This is when empires are built. Military reach expands. Trade dominance grows. Influence spreads globally. The currency begins to travel. Foreign governments hold it. Global trade settles in it. Commodities are priced in it. At this stage, the currency isn't just money. It becomes infrastructure. Today, this looks like the US dollar system. Over 80% of global trade finance still touches dollars. More than 12 trillion in foreign reserves are held in US currency. Oil, debt markets, and global settlement all orbit the same core. As long as growth continues, nobody questions the foundation. Stage 3, the leak begins, then the math turns. Debt grows faster than productivity. Money supply expands faster than real output. The currency doesn't collapse. It leaks. Prices rise, but unevenly. Assets inflate first. Stocks, real estate, financial instruments, necessities follow later. Housing costs surge. Food prices climb. Energy becomes volatile. Wages lag behind all of it. This is the stage we're in now. U.S. federal debt surpasses 34 trillion. Annual deficits measure in trillions, not billions. Interest payments alone rival defense budgets, yet nothing breaks. Because governments lose flexibility before they lose control, rates can't rise too much, or debt servicing explodes. Spending can't be cut, or backlash follows. Printing can't stop, or markets seize. So the system keeps expanding. This is not corruption, it's structure. Stage 4, movement without collapse. Here's the part almost nobody sees. Stage 4 does not begin with a crash. It begins with movement. The same institutions that help build the system, banks, asset managers, pension funds, begin repositioning, quietly, gradually, mathematically. They don't wait for disaster, they don't announce concern, they rebalance. Capital shifts toward regions with psi, higher growth capacity, manufacturing depth, psi, demographic scale, supply chain control, early enough that the move looks responsible, not panicked. By the time the public senses something irreversible, the repositioning is already complete. This is when populations get trapped. They hold the currency because it still works, because it's familiar, because collapse hasn't happened. But purchasing power keeps eroding. This is how wealth transfers happen without confiscation, not through force, through dilution. And here's the uncomfortable truth history confirms every time. This mechanism has never failed to finish. It ended Britain's dominance. It wiped out Germany's middle class. It reshaped the US dollar after 1971. Each time the structure was identical. Each time capital moved first. Which is why what happened between 2018 and 2020 matters so much. Because while the public was told one story, the machine was executing another. And once you understand this, one realization becomes unavoidable. Systems don't collapse because leaders make bad decisions. They decline because the system follows its own logic perfectly. And right now, that logic is active. If you only watched the headlines between 2018 and 2020, the story felt simple. The United States was finally pushing back. Tariffs were slapped on hundreds of billions of dollars worth of Chinese goods. Presidential speeches promised toughness. Cable news framed it as a turning point, a showdown between two economic giants. The message was emotionally satisfying. Manufacturing would return, trade imbalances would shrink, economic dominance would be defended. It felt like conflict. But real economic conflict doesn't look like this. It doesn't rely on speeches, it doesn't announce itself on television, and it certainly doesn't play out where the public is watching. Because while the world focused on tariffs, something else was happening underneath, quietly, methodically, at historic scale. Between 2018 and 2020, U.S. and Western financial institutions increased their exposure to Chinese markets by over 1.4 trillion, not hypothetically, not over decades, in just a few years. And here's the detail that changes everything. The largest inflows happened in 2020, the absolute peak of the trade war. At the exact moment tariffs were highest, capital commitment was accelerating. That is not confusion. That is not bad timing. That is deliberate positioning. To understand why, you have to understand how institutional money actually moves. Most people imagine investment as belief, executives deciding what they think will happen. That's not how trillion-dollar capital behaves. Pension funds, insurance pools, endowments, sovereign wealth funds, they don't make emotional bets. They follow indices. And indices are the plumbing of global finance. When a country is included in major benchmark indices, capital doesn't debate, it flows. automatically. In 2018, a decision was made that barely registered outside financial circles. Chinese domestic equities, known as A-shares, began formal inclusion into global benchmark indices tracked by tens of trillions of dollars. This wasn't political. It wasn't ideological. It was technical. Market access improved. Liquidity deepened. Settlement systems matured. And once those conditions were met, the switch flipped. Firms like BlackRock, JPMorgan Chase, and Goldman Sachs weren't choosing sides. They were responding to structural inclusion. When China entered those indices, portfolios tracking them had no choice. Capital flowed in by mandate. This is the brutal irony of the trade war. At the exact moment politicians were signaling resistance, the architecture of financial integration was being finalized. You cannot decouple manufacturing while your financial system is integrating at scale. You cannot confront an economy while your own pension funds are structurally funding it. You cannot claim opposition while your largest institutions are preparing for the next cycle. That contradiction wasn't accidental. It was stage 4 behavior. Public conflict creates noise. Noise creates cover. Cover buys time. And time is the only thing late-stage systems need. This is not new. British citizens in the 1800s didn't realize their savings were financing America's rise. German households in the 1920s didn't see foreign capital positioning ahead of collapse. And today, most Americans don't see how their system is quietly reallocating global power, not because people are uninformed, but because the system is designed to be invisible. Tariffs are loud, index reweighting is silent. Political theater dominates attention. Capital plumbing operates underneath it. Here's the deeper truth. The trade war was never designed to win. It was designed to manage perception, to reassure the public that control still existed. That decline wasn't being conceded, that strength was being projected. But capital doesn't care about reassurance. It cares about relative future growth. By 2018, that calculation had already been made. The illusion of conflict kept confidence intact. The movement of capital prepared for what comes next. And once you see that, the contradiction stops feeling confusing. It becomes logical, because stage 4 doesn't require collapse. It only requires enough time for capital to reposition, while the public continues holding the currency, believing stability still exists. And this leads to the next realization. This pattern didn't start with the trade war, and it didn't start with China. It has completed itself before 3 times. And the fastest way to understand where this is going now is to look at how it ended the last 3 global monetary powers. If this were happening for the first time, it could be dismissed as coincidence, a strange alignment of politics, markets, and timing. But it isn't new. In fact, it's so old and so consistent that once you line the cases up side by side, denial becomes impossible. Every global monetary power follows the same arc, and every time, the final phase looks almost identical from the inside. Let's start where the modern system truly begins. Britain, the original blueprint. By the late 1600s, Britain was powerful and nearly broke. Wars were expensive. Empire was expensive. And taxation had limits. So in 1694, a revolutionary solution appeared, the Bank of England. The arrangement was simple and world-changing. Private financiers lent money to the government. The government guaranteed repayment with interest. That debt became circulating money. Stage 1 was complete. Debt exploded, not because the system failed, but because it worked. By the 1800s, Britain dominated global trade. The pound sterling settled international commerce. London became the financial center of the world. This was stage 2. But by the mid-19th century, the math shifted. Industrial productivity in the United States and Germany began to outpace Britain. The cost of empire rose faster than output. Debt kept growing. And here's the part most textbooks glide past. British capital didn't wait for collapse. It moved. British money financed American railroads, American steel, American industry. By the time the pound officially lost reserve status in the early 20th century, the next system was already built. The public held the currency. The architects held the future. Germany, compression accelerated now. Jump forward to the aftermath of World War I. Germany was buried under reparations denominated in foreign currency. Taxes couldn't cover them. Exports weren't enough, so the government chose the only path that kept the system functioning. They printed. Between 1921 and 1923, the money supply exploded. At the peak, prices doubled every few days. Savings were wiped out. The middle class was erased. This was stage 3, compressed into months instead of decades. Here's the critical pattern. The collapse didn't arrive randomly. It arrived after debt became unpayable. And once the destruction was complete, foreign capital arrived. Loans restructured the system. Assets changed hands. Influence shifted. Once again, capital survived. The public absorbed the loss. The United States. The quiet redesign. Now the most important case, the one that built the world you live in. After World War II, the United States emerged with unmatched power and the majority of the world's gold reserves. In 1944, the Bretton Woods system was created. The dollar was backed by gold. Every other major currency was backed by the dollar. Stage 1, Stage 2. For roughly 20 years, it worked flawlessly. Global trade ran on dollars. Foreign central banks accumulated U.S. reserves. America financed wars, infrastructure, and social programs without immediate consequence. But by the late 1960s, the numbers broke. Too many dollars, not enough gold. Foreign governments noticed. They began demanding physical gold in exchange for paper dollars. This was the moment discipline should have returned. Instead, the rule was broken. In 1971, President Nixon closed the gold window. The dollar became pure fiat. Stage 3 began. Inflation followed. Purchasing power eroded. Debt became permanent. Yet there was no collapse. Why? Because the system adapted. Financial markets expanded. Debt instruments multiplied. Dollar usage spread even further. Confidence replaced discipline, and for decades that illusion held. But erosion never stopped. Today, U.S. debt exceeds $34 trillion. Money creation accelerates during every crisis. Confidence is maintained through narrative, not constraint. And just like before, capital begins looking elsewhere. Not out of betrayal, not out of ideology, out of pattern recognition. This is the realization most people resist. What feels like decline is not chaos, it's transition. And transitions don't announce themselves. They reveal themselves through capital movement first, not headlines. Which brings us back to now. Because once you understand this pattern has already completed 3 times, the question isn't whether it repeats, it's where it completes next. This is where the pattern becomes hardest to accept. Because unlike Britain in the 1800s or Germany in the 1920s, you're not reading about this in a history book. You're living inside it. And when you're inside a system, the most difficult thing to see is the water you're swimming in. Right now, everything still appears functional. The currency still buys groceries, paychecks still arrive, markets still open every morning, planes still fly, oil still flows, trade still happens. And that's exactly why this stage is so dangerous. Stage 3 never feels like collapse. It feels like normal, with friction. Prices rise, but gradually. Debt grows, but quietly. Money printing becomes routine instead of shocking. Each crisis justifies the next expansion. 2008, 2009, 2010, every time the same solution appears. More liquidity, lower rates, bigger balance sheets. And every time the explanation sounds reasonable. We had no choice. This is temporary. This prevented something worse. And maybe in the short term, that's even true. But patterns don't care about intentions. They care about outcomes. And the outcome looks like this. The money supply grows faster than productive capacity. Not once, not occasionally, structurally. When that happens, purchasing power doesn't vanish overnight. It leaks, slowly enough that people adapt instead of revolting. Housing becomes unaffordable, but only in certain cities at first. Food prices rise, but just a few % per year. Energy costs spike, then settle higher than before. Savings lose value, but it's blamed on everything except the currency itself. Supply chains, geopolitics, greed, corporate pricing. The explanations change. The result doesn't. Now add something that didn't exist in earlier cycles, at least not at this scale: financialization. Today's economy doesn't just produce goods, it produces assets, stocks, bonds, derivatives, real estate. Financial claims on future cash flows. When new money is created, it doesn't flow evenly. It flows into assets first. Markets rise before wages do. Property values jump while incomes lag. Portfolios inflate while paychecks struggle to keep up. That's why you see a contradiction everywhere. Markets near record highs, households under pressure. That's not hypocrisy, it's mechanics. Those closest to capital benefit early. Those dependent on wages feel it last. And, hardest, this is how inequality widens without a single law being passed. And this is where the political confusion comes from. People feel something is wrong, but every explanation feels incomplete because the real cause isn't partisan, it isn't cultural, it isn't moral, it's mechanical. Now zoom out and look at what capital is doing today. Not what politicians say, not what headlines emphasize. Look at flows. Capital isn't fleeing chaos, it's repositioning toward capacity, manufacturing depth, demographic scale, supply chain control, ability to absorb volatility. That's why financial institutions don't wait for official decline. They don't need collapse. They only need relative change. If one system can grow faster over the next 20 years than another, that's enough. And that's the calculation happening now, not in secret rooms, in models. This is why the contradiction between rhetoric and capital movement exists. You can't fight a structural pattern with speeches. You can't reverse a debt-based system without pain, and you can't maintain reserve status indefinitely while expanding liabilities faster than output. Every reserve currency reaches this moment. The moment where confidence remains, but discipline is gone. The moment where the system still works, but flexibility is lost. The moment where the only politically acceptable solution is the one that worsens the long-term outcome. Borrow, print, delay. This isn't a failure of leadership. It's a failure of structure. And structures don't change until they're forced to. This is why comparisons to the past feel uncomfortable, because the people living through those transitions didn't feel doomed either. They felt confused, frustrated, pressured. They felt like the rules changed without being told. That's exactly what this stage feels like, not collapse, compression, the system tightening around households while capital quietly finds air elsewhere. This is the calm before recognition. The moment before the broader public realizes what's happening isn't cyclical, it's transitional. And once that realization spreads, the final stage doesn't begin with panic, it begins with acceptance. Which brings us to the most uncomfortable question of all. What happens when people finally understand the pattern, but it's already too late to stop it? Here's the part that makes people uncomfortable. Because once you understand the pattern, you can't unsee who it rewards and who it quietly extracts from. Every transition like this creates three groups. Not by conspiracy, not by coordination, by consequence. The first group, those who move early. This group is small, but powerful. Institutional investors, asset managers, pension allocators, sovereign funds. They don't need headlines to tell them something is changing. They watch debt trajectories. They watch central bank balance sheets. They model demographics, productivity, and long-term growth capacity. When the signals align, they don't argue. They reposition. Quietly, incrementally, legally, they diversify currency exposure. They increase allocations to regions with higher future output. They shift from cash sensitivity to asset resilience. From the outside, this looks like normal portfolio management. From the inside, it's stage 4 behavior. They're not predicting collapse, they're avoiding dilution. The second group, those who adapt late. This group still has flexibility, but less time. Corporations, high-income professionals, business owners, they feel the pressure first. Margins tighten, costs rise, financing becomes unpredictable, so they adjust. Prices are raised. Contracts are renegotiated, supply chains are restructured, income is shifted into assets that lose value more slowly than cash. They don't escape the transition, but they soften the impact. The third group, those who carry the weight. This is the largest group. Households, workers, savers. People whose income is fixed in nominal terms while prices float freely. This is where the transfer happens, not through confiscation, not through sudden taxation, not through collapse, through purchasing power decay. When money loses value slowly, people don't revolt. They adjust. They downgrade expectations. They delay milestones. They accept smaller lives in exchange for stability. This is how wealth transfers without alarms. Now look at recent inflation through this lens. Asset prices surged first. Those who owned assets felt wealthier, even as the currency weakened. Those without assets felt the squeeze immediately. Rent rose, food rose, energy rose, wages followed last. This wasn't accidental. It's how debt-based monetary systems resolve imbalance. That's why the economic conversation feels fractured. One group says, the economy is strong. Another says, I can't afford anything. Both are right from where they're standing. Why capital moves where it does this is where China and similar growth systems re-enter the story. Capital doesn't move because of loyalty. It moves because of arithmetic, manufacturing density, labor scale, supply chain control, willingness to absorb volatility. Capital flows towards systems that can grow into the next cycle, not systems struggling to preserve the last one. This doesn't mean collapse is imminent. It means gravity is shifting, and gravity never asks permission. Why policy can't stop the transfer. As capital repositions externally, policymakers face impossible choices internally. Support growth without triggering inflation, without crashing asset markets. Maintain confidence without restoring discipline. So they choose the least immediately painful option. Delay. More borrowing, more liquidity, more reassurance. Each decision feels reasonable in isolation. Together, they accelerate the transfer. This is why people feel stuck, working harder, saving less, moving nowhere. They're not failing. They're standing on the wrong side of a system in transition. And here's the most dangerous consequence of all. Once people realize the system isn't broken, it's just changing players. Trust erodes, not suddenly, quietly. And when trust erodes, behavior changes. That's when the final phase accelerates, not through panic, through adjustment, which brings us to the most critical moment in every cycle, the moment belief starts to crack. There's always a moment in every cycle when something subtle changes. Not markets, not currencies, not policy, behavior. It begins quietly. People don't panic, they hesitate, they stop assuming tomorrow will look like yesterday. They question decisions that once felt automatic. They become cautious, not because they're afraid, but because something no longer feels solid. This is the recognition phase, and it's the most dangerous stage of the entire pattern. Because money doesn't survive on math alone, it survives on belief. Belief that money saved today will still matter tomorrow. Belief that effort leads to progress. Belief that stability is the default, not the exception. When that belief weakens, the system doesn't collapse. It changes character. Look around. People no longer ask, how do I get ahead? They ask, how do I not fall behind? That shift alone tells you everything. Savings behavior changes first. Cash stops feeling like safety. Holding money feels like accepting loss. People tolerate more risk, not because they want to, but because standing still feels worse. Assets become protection instead of opportunity. Debt becomes survival instead of leverage. This is how bubbles form without optimism, not driven by greed, but by defensiveness. Now look at institutions. Banks don't stop lending. They lend more selectively. Governments don't stop spending. They justify it more aggressively. Central banks don't tighten decisively. They hesitate, because tightening breaks something, and everyone knows it. This is the trap of late-stage systems. Every lever still works, but only briefly and with side effects. Raise rates too much, debt servicing explodes. Cut spending, political backlash. Stop printing, markets seize. So policy becomes reactive instead of strategic. Short-term calm replaces long-term resilience. And that choice, repeated year after year, accelerates erosion. This is why the recognition phase doesn't arrive with a headline. It arrives with fatigue. People grow tired of explanations, tired of being told things are improving while their lives say otherwise, tired of narratives that don't match experience. That exhaustion matters, because when people stop arguing and start quietly adapting, belief has already cracked. Now here's the part. History repeats perfectly. By the time the public broadly recognizes what's happening, capital has already adapted. Not just moved, restructured itself for the next cycle. New financial centers, new settlement rails, new trade corridors, new capital markets deep enough to absorb flows. These don't appear overnight. They grow quietly while the old system still functions. That overlap is intentional. It prevents panic. It buys time. It allows the transition to finish without interruption. This is why stage 4 is invisible until it's irreversible. People expect a warning, a crash, a siren, a breaking news moment. But those are endpoints, not signals. The real signal is behavioral. When people still follow the rules but no longer trust them. When they hedge without admitting they're hedging. When they adjust without saying why. That's when belief has already slipped. And once belief slips, velocity changes. Money moves differently. Spending patterns shift. Risk tolerance adjusts. Those changes feed back into the system itself. Inflation becomes harder to control, not because of supply, but because expectations are unstable. Policy becomes less effective, not because tools are gone, but because trust is. This is the final psychological hinge. The moment when the currency still works, but no longer anchors confidence. At that point, the endgame doesn't require collapse. It completes through drift. The old system fades, the new one solidifies. And one day, people look back and realize something fundamental changed. Without remembering a single day it happened. That's how reserve currencies actually die. Not with sirens, with silence. And that brings us to the final question. If recognition always comes late, if belief cracks quietly, is there anything that actually changes the outcome? Or is the final stage already locked in? Every system like this ends the same way, just not how people imagine. There's no single crash button, no dramatic overnight reset, no moment where everything suddenly stops working. The final stage isn't collapse. It's normalization of decline. By the time the pattern completes, most people have already adapted to less. Less purchasing power, less certainty, less faith. That effort alone guarantees progress. And that adaptation is what allows the transition to finish quietly. Because reserve currencies don't die when they're abandoned. They die when they're tolerated. When people keep using them not because they trust them, but because there's no immediate alternative, that's when the system finishes transferring value. At this stage, the architecture of the next system is already standing. Trade routes have shifted. Financial infrastructure has matured elsewhere. Capital markets outside the old core are deep enough to absorb flows, not perfectly, not smoothly, but sufficiently. This is the moment where headlines still talk about dominance, while reality moves on without asking permission. The old power doesn't vanish. It still exists, militarily, culturally, politically, but its financial gravity weakens, and financial gravity is what shapes the future. This is why transitions like this don't feel like defeat, they feel like confusion. Why doesn't hard work stretch as far anymore? Why does stability feel temporary? Why do good economic numbers fail to translate into better lives? Because the system that once amplified growth is now redistributing scarcity. And scarcity doesn't announce itself loudly. It shows up as friction, more paperwork, more fees, more delays, more hoops to jump through. Life gets heavier without becoming dramatic. That's how the final stage completes. Now here's the part most people are never told honestly. This outcome isn't prevented by optimism. It isn't stopped by slogans. And it isn't reversed by pretending the pattern doesn't exist. Every population that avoided the worst outcomes of these transitions did one thing differently. They understood the mechanism before it finished executing. Not to panic, not to rebel, but to adjust assumptions. They stopped measuring success purely in nominal terms. They stopped trusting systems simply because they were familiar. They stopped believing stability was guaranteed by tradition. They asked harder questions. What actually holds value in a system built on debt? What survives currency erosion? What remains useful regardless of who controls the financial center? Those questions don't have political answers. They have structural ones. And that's the uncomfortable truth. This isn't about America versus China. It's not about left versus right. It's not even about good actors and bad actors. It's about a machine that runs until it exhausts its own logic. And right now, that machine is nearing the end of its cycle. Not tomorrow, not next month, but unmistakably. Capital movement already confirms it. Institutional behavior proves it. Household exhaustion reflects it. And history guarantees how it resolves. The population holds the currency as its power fades. The architects hold assets aligned with the next system, and the transition completes without asking for permission. That's the pattern. And the most dangerous mistake at this point is assuming you'll get a clear warning before it matters. You never do. The warning is subtle. It's already here. It's the feeling that the rules changed, quietly, and nobody explained when. So here's what this all comes down to. You're not watching a random series of economic shocks. You're watching a historical mechanism reach its later stages. The same mechanism that ended British dominance. The same mechanism that destroyed Germany's currency. The same mechanism that transformed the dollar after 1971. It doesn't need collapse to succeed. It only needs time, and time has already been spent. This isn't prediction. It's pattern recognition. And pattern recognition doesn't tell you what to believe, it tells you what not to be surprised by. Rising costs, persistent inflation, quiet shifts in global financial power, and a future that won't resemble the last 30 years. The people who struggle most in moments like this aren't the ones without information. They're the ones who assume normal will return. Normal was a phase, not a guarantee. The question now isn't whether the pattern completes. It always does. The only question is whether you recognize it early enough to stop being confused by it. With that said, thanks for watching, and until next time.